Let's start with the gold prices, which are trading weak as the robust U.S. economic data and the strengthening U.S. dollar continues to dim the bullion safe haven appeal. On your screens, you have the gold prices down nearly 0.3%. It's still holding above $1,200 per ounce, but the markets really are looking at a second week of gains coming in for the gold at this week. But there is no respite in the sight for the crude oil producing nations. The International Energy Agency expects the prices to fall further. Slower demand and rising output from non-OPEC nations will continue to worsen the global supply glut. The agency, which coordinates energy policies of industrialized nations, cut its outlook for global oil demand growth for 2015 by 230,000 barrels per day to 0.9 million barrels on a daily basis. Expectations are that the fuel consumption in Russia and other oil exporting countries will decline next year. This is the fourth cut in demand estimated by the IEA in just 5 months. For net oil importing countries like India, this is certainly good news. The government can enjoy the fiscal room given by low oil prices for longer than earlier expected. Let's do a price check as well, and let's get the Brent and the NYMEX prices on your screens, where we have seen the Brent just about trying to hold that $63 per barrel mark. Remember, it's a 5.5-year lows coming in for the prices, 1% of a cut for the Brent, and the NYMEX actually has broken below $60 per barrel also. Also, if you talk about the Canadian crude oil prices, those are now struggling to keep at $40 per barrel, so that's the kind of decline that you have seen coming in for this area. Let's get on board then. Vijay Bambani, who's author and CEO at BSPL India. Also joining us is Tarun Satsangi, who's head commodity and currency at Globe Commodities. Vijay, hi, let's start with you first, and let's start with energy markets, because this week as well, a 10th one in row is closing on a negative bias.
Good evening, Manisha. And the pressure on energy prices does continue. And as a matter of fact, yesterday was the second or third session where I advocated a buy at low points of the day, and ranging from 20 to 50 rupees, the prices have closed low from where we advocated a buy. Mercifully, these were trades that I initiated and advocated closing by the end of the session, so the damage has been minimal, but the fact remains that any kind of small size buys are also yielding small losses. So unless there is a positive closing, I would say that the pressure is likely to continue, although the impetus, the momentum at downward levels might just slow down below the 3600 levels. So I would advocate not shorting crude at this point in time, because the markets are appearing oversold, although I've advocated earlier that oversold status can remain in a bear market, and therefore I would not want to short now, but it's a little premature to even buy. So you need to wait and watch. Add to it the weekend factor, wherein volatility might just be heightened in the fag end of the session. So basically, fresh trades may be deferred to Monday now.
Well, that's on your screens. The crude MCX also down nearly 10% in this week as of now. Tarun, what's your sense coming in for the energy markets? Are you surprised? Are you buying? Are you holding these positions? Or would you want to take a fresh note as well on Monday?
Yeah, pessimism is very much on in energy market, and I think we would like to hold our negative view on crude for a while also. It may slide to $50 a barrel in the coming weeks, and prices have already lost 40% since the start of this year, and that is because of the rising pace of supply, especially from US shale production. And despite falling prices, OPEC is not actually intervening into the market to prop up prices by cutting their production. Even message is pretty much clear: they don't want to give benefit of production cut to other nations, or candidly, they want to discourage US shale production at this juncture. At the same time, in order to defend their market share, we have seen some of the OPEC members are giving handsome discount to US and Asian buyers, and in this aspect we have seen Saudi Arabia and Iraq and Kuwait, who have done this recent in last 2 weeks, which has dented outlook of crude substantially on negative side. So it is sell on rise counter heading towards $50.
Mm-hmm. Well, it's not just the brokerages and banks which are cutting the outlook for crude oil prices, Vijay. It also has to do with OPEC, where they say that their demand for their crude oil is going to fall to 12-year lows in 2015. And of course, we have IEA as well today talking about lower demand continuing into the next year as well. That definitely doesn't do anything for the sentiment. And as you said, even as it's oversold, you might see further declines.
You're right, Manisha. OPEC and the IEA guidance might just add bearish evidence onto the prices. But I have a feeling these guidances normally tend to come a little late. The majority of the decline is already done and over with, and now to come out and say at sub $60 that demand is going to contract, to my mind, I think it's coming a little too late. So the markets have already factored in majority of the worst case scenarios. Now, from here on, I would not give more than 10-15% of a decline in crude. So if you are a positional trader, you may be at lower levels would want to start nibbling into long positions. Of course, at lower levels, not at the current price points. And shorting at this point in time is fraught with risk, because the risk-reward ratio at this point in time does not really favor a short seller.
Let's also get in one more view, and joining us on a Delhi phone line is Mr. Narendra Taneja. Remember, he's an expert on energy. Mr. Taneja, hi, good to have you on the show. What's your sense coming in, especially after the forecast from OPEC and now followed from IEA as well, that we are staring at further decline in global demand, especially for the crude oil?
Well, that's right. I mean, that seems to be, that's why there's a bit of, anxiety in the oil industry and the gas industry also, because since gas is so closely linked with oil in terms of prices and sentiments. So my own assessment is that, okay, it looks like we are moving in that direction, and maybe we are moving in the direction of, below 60. But the big question remains whether that price is sustainable. My own kind of assessment is no, not sustainable. I think you will find big political forces, big countries to, intervening, because anything less than 60 on a sustainable basis will have serious consequences for the world economy as a whole, not only the financial world economy as a whole. It will start with shale business in the United States, and then you will see that having impact on a lot of other countries, mainly oil exporting countries, even non-OPEC like Russia. But it will move very fast beyond that and will start having adverse impact on big global manufacturers such as China. It's only a matter of time. So my own kind of assessment is that, probably big platform like G20, if not G20, at least, Western countries, mainly the United States, would intervene, and they will try to see that, things do not get a bit out of control and prices are stabilized in the region, which can basically, help the global economy. Anything less than 60, would really have very, very serious consequences for the global economy. Forget about oil or gas. I think it will start hurting the global economy almost instantly.
Absolutely, Mr. Taneja, because we are looking at below $60 for the NYMEX prices. It's almost nearly $40 when it comes to the Canadian oil prices, and the Brent just about holding that 62, 63 mark. Where do you see a support coming in? Where do you see those concerns, those interventions from the producing countries coming in?
Well, you see, the point is that, producing countries, they have already tried their level best. And we have also seen at the same time, within OPEC, Saudi Arabia, Kuwait, and Iraq, they seem to they've decided to persist, which means that, without these countries, OPEC actually has lost the muscle. And so far, it seems that to these three countries, America's shale is the biggest headache, and right now they're trying to basically address that. And Saudi Arabia in between somewhere is also basically obsessed with Iran, because if oil prices go, in terms of Brent, if oil prices go below 50, it will hurt Iran like never before. And that's precisely what it looks like Saudi Arabia wants. Because of Saudi Arabia, Iran is enemy number one, and the others come only later. So I think somewhere, big thing going on, and Russia is also, very worried about it, but it looks like today Russia is not able to do anything. OPEC has more or less become a seriously divided house, and Saudi Arabia, and they have their own agenda. And so far, America, the big power, when it comes to oil, has decided not to intervene. But we have to wait and see when the U.S. decide to basically intervene. It may look like to those who follow only market, the market decide everything. But when it comes to oil, yes, market is a bit there, but behind the market, there are many other players. They're not visible. very often you don't even can identify them, but they are the ones who are at play right now, and I think they are the one who very soon the U.S. government and other governments will start interacting with, and then you will only start seeing, because nobody can afford at this stage, just because of oil, the whole world economy slipping into unprecedented situation. This time, if oil price Brent goes to 40, you will see something more serious than what we saw in 2008.
Fair point, Mr. Taneja, and we hope that the situation doesn't arise yet again, but that's the view really coming in for the crude oil prices. Now, it really is becoming a big concern the way the prices are falling, and many of these producing countries where the budgets are seriously mismatching now, it really is becoming a problem for the economy too. Let's take a look at the gold prices, which are holding above 1200. It's a second week of gains, but we have seen price decline coming in today. Tarun, how would you look at the precious metal space, the way they seem to be behaving today?
I think since hitting a low of $1130 in the month of November, it has been reacting more positively, and we have seen some support coming in because of Chinese and European slowdown concern, which, if deepens further, may reiterate safe haven appeal of gold for a while. At the same time, benign inflation and weak energy prices are rising threat for sustainability on higher side. But for short term, I think we could sell it around 27,300 for a target price of 27,000, keeping a very tight stop loss of about 27,370. In overseas market, it may slide to 1,200. If those levels hold on, then in that case we may see again rally continuing towards $1,250, $1,270 in the coming weeks.
Vijay, how would you look at the base metal space? Because the US data has been positive and China seems to be injecting cash yet again into the banking system. Do you see that supporting this sector?
Manisha, a year-end technical pullback rally cannot be ruled out because most of these industrial metals have been hammered down. The hedge funds, the international hedge funds, which happen to be the largest participants in the market, which I've talked about, are likely to cover some shorts, and therefore you're seeing bellwether industrial metals like copper, etc., coming out and witnessing buying support at lower levels. It's actually not fresh buying. It's more of short covering towards the end of the year, because a bear will book profits only by covering his or her shorts. And what I am seeing on my screens is proactive short covering with very marginal fresh buying. So I would say that individually speaking, copper is likely to encounter some mild support at 402, 404 levels, nickel at 1010, 1005 levels, lead at 122, zinc at 133, 132 kind of levels. If I was to get those prices, I might just go out there and start getting my toes wet for small size long positions, provided the screen, that is the price volume and open interest correlation, tells me that there is proactive short covering and or fresh buying. I think a technical pullback would be in the offing, and more so towards the end of the calendar year.
Tarun, what's your sense coming in for the lead prices? Are you buying or selling at these current levels?
Looking at the economic condition of Europe and China, we prefer to remain on selling side in most of the base metals. I think it has given decent breakdown yesterday, and we see it falling towards 121 odd levels before finding any support. And this counter can be sold around 125.50 to 126 odd levels, and our stop loss would be somewhere close to 128 on higher side.
Well, that's about the non-agro space. Let's talk about some agro commodities also, and the sugar prices have continued to decline. This is a fourth straight week of a fall coming in for the sugar prices, and we have seen very sharp declines in sense of prices. Tarun, how would you look at this commodity, and where do you see a support coming in now?
I think it may decline by 3 to 5% in the coming weeks. Higher carryover stock from last year and better start of output this year has resulted into supply glut, and if we talk of activity in derivative and CDX bourses, then I think March derivative can be sold around 27.50 for a target price of 26.90, and stop loss would be placed around 27.80 on higher side.
A sharp 6% of a decline coming in for the sugar prices for this week, and it hasn't been very choppy really for the pulses space. Vijay, how would you look at trading chana now?
Manisha, cyclically speaking, chana will start attracting investor focus close to March or April. And at this point in time, I would maintain my view that the 3050 to 3150 range is a very stiff resistance for the bulls to overcome. Unless this resistance is overcome very forcefully in terms of higher traded volumes on the breakout, open interest expanding by at least 25-30% on a day-on-day basis rather than intraday basis, I would still maintain that chana prices are either going to remain sideways or under pressure. If you give me 2,700 or 2,725 odd levels, I might be tempted to buy, but at present prices, I'm not very keen a buyer on chana.
And in the spices space, it is jeera which has seen gains continuing for 2014 on the back of not so good weather, not favorable weather. What's your sense, Tarun? At these current levels, are you still looking to go long?
Yeah, we have seen a gain of around 20% since October on account of strong export demand, mainly because of limited supply in other two major suppliers in the world, that is Turkey and Syria, and that has resulted into shift in demand to Indian markets. I think positive phenomena will continue for some time also, and current crop progress is also underpinning the same. We prefer to buy January jeera derivative on dips around 12,900 with a stop loss below 12,600 for a higher side target of 13,700.
All right, Tarun, we will let you go at that. Thank you so much for joining us with your strategies on the agro and the non-agro space.